And now I'd like to introduce today's special speaker. The Christmas season is well upon us, and I think Diane Brisbois, the President of the Retail Council of Canada, who joins us here at the head table, I hope would confirm that Canadian consumers are shopping and that confidence is very high in Canada. Inflation is down and retail prices adjust to the strong Canadian dollar, and last week the Bank of Canada took the step of lowering the overnight interest rate. As the year winds down to a close, it's a good time to take stock of this year and that was. There was the subprime mortgage crisis, a bombshell that roiled U.S. markets. The ripples will continue to be felt here and around the globe for some time. The new super loonie may buffer the effect of international instability on the Canadian economy. And while it's perhaps good for consumers, it's clearly not been so good for manufacturers and exporters. Will the loonie settle down, or will it continue to ascend and swoop through the new year? Certainly it's been a bit of a thrill ride this year, particularly since June, but thrills are probably better suited for a fairground than our economy. When it comes to the Canadian financial system, I think we'd all prefer safety and security, because the freedom and ability of Canadian families and firms to confidently hold and transfer financial assets is one of the fundamental building blocks of our economy. And that's where the Bank of Canada comes in. For 7 decades, the bank has been the guardian of Canadian financial stability, committed to promoting the economic and financial welfare of Canada, fostering a safe and efficient financial system. It goes without saying that the international financial system is large and complex, safeguarding our own economy from disruptions originating here or abroad, to financial institutions, markets, to clearing and settlement systems is the sworn duty of the Bank of Canada. As we head to the end of 2007 and into 2008, we should also make mention of another very important date, and that is the end of Governor David Dodge's tenure. Since 2001, David has put his expertise on the line 8 times a year, marking periodic interest rate policy and policy announcements. It's a delicate task. For 7 years, his job has been to keep the economy chugging along with just a hint of manageable inflation. He's widely respected by economists in Canada and abroad for his insight, his courage, and his openness. He has been a steady hand at the tiller and an able captain through both smooth and rough waters. And I understand David and his wife are going to be taking some time over the next 6 months to do some sailing. He joins us here today to offer his reflections on the Canadian financial system. Ladies and gentlemen, please join me in welcoming our very special guest, the Governor of the Bank of Canada, David Dodge.
Well, thank you, Alan. It's a tremendous pleasure to be here with you today in Toronto. It's just 7 years since I was standing here in front of you to give my first speech as governor, and being a native of Toronto, the alpha and omega of speaking, being here in Toronto, is a particular pleasure for me. So thank you very much for coming today. It is a bit of a tradition that at this time of year I do give a speech about the financial system. We've done that since 2004, where it started at a joint meeting of the Empire and Canadian clubs, when I talked first about efficiency and the need to promote financial efficiency in Canada. Now, you know, people always ask why the bank, with its well-known responsibility for monetary policy, puts such emphasis on financial system issues. Well, the real answer is the two are very tightly linked, and I'm going to talk about monetary policy a little later. But first, I want to look back over the past 7 years, but in particular over the past 7 months, and discuss some of the developments we've seen in our financial system. I'll start with a very brief overview of the bank's role, and then I'll discuss the dislocations in financial markets that began during the summer, and talk about how problems related to information contributed to that market turbulence. And then finally, I'll look at the effects of these events continue to have both on financial markets and on the outlook for the Canadian economy. Now, ladies and gentlemen, one of the reasons for giving these speeches near the year end is so that they coincide with the publication of the bank's December financial system review. And that review was just published last week. And what it does is to provide some of the context which we hope will lead to a stronger financial system in Canada. The one we published last week deals extensively with the market turbulence which began this summer. Now, the bank works very hard to promote a financial system that's both stable and efficient. And I've already mentioned that financial instability can impair our ability to conduct monetary policy. Thus, we're very interested in a stable financial system. But a stable financial system is important to everyone because it is crucial for an economy to function well. In Canada, the responsibility for promoting financial stability is shared by a number of agencies. Our partners include the Department of Finance, OSFI, CDIC, provincial regulators, and securities commissions. The bank's also the ultimate provider of liquidity to facilitate the settlement of financial transactions and is the lender of last resort to the financial system. But there is no single body responsible for promoting financial efficiency, despite its importance. The Bank of Canada contributes to it through our monetary policy to keep inflation low, stable, and predictable. And we have a legislated role to oversee Canada's most important clearing and settlement system. And what we do is we do a lot of research on financial system issues, which we publish in the Financial System Review and our other publications. Over the last 4 years, I've tried to highlight some important issues for Canada. In 2004, for example, I spoke of the need to promote efficiency in our financial institutions and argue and continue to argue, and we continue to research this, that our policy framework should provide greater incentives for innovation by encouraging competition, while at the same time giving our institutions the scope to improve efficiency. And here there remains a lot of work to do. I subsequently have spoken about the need to improve Canada's securities regulation so as to have uniform laws and regulation based on principles that apply to everyone, but tailored to take into account the differing size and complexity of firms. Now, there hasn't been as much progress here as I would have hoped, so Canada still does remain at risk of seeing its capital markets eroded as business migrates to other financial systems. But some progress has been made, and one of those areas where there has been progress is to increase the efficiency of our exchanges. And the merger of the Montreal Exchange and the TSX announced today is a welcome and very important step in that direction. I've also talked about the need to improve enforcement in securities markets because markets work more efficiently when rules are enforced and seen to be enforced. I welcome the commitment of the RCMP to improve and implement many of the recommendations set out by Nick Lepin in his report last week. However, ladies and gentlemen, much better cooperation and coordination of efforts among securities commissions, law enforcement agencies, prosecutors, and ministers of justice and attorneys general is absolutely crucial. Such coordination and cooperation is difficult to achieve, but the payoff will be very high. Another area that I've raised is the need to strengthen Canada's regulatory, legal, and accounting frameworks related to defined benefit pensions so that risks are dealt with in an appropriate way. Pension funds can generate important gains in terms of economic efficiency, and reviews of regulations are underway both at the federal and provincial levels. If we can collectively get these changes right, and sponsors have the appropriate incentives to manage risk effectively, this will enhance the viability of our system of private, voluntary, defined benefit pensions for the benefit of workers, for the benefit of firms, and for the benefit of our capital markets. Now, all these issues are critical for Canada's future economic prospects, and as I said, the role of the bank has been to do research and provide analysis to inform public policy in these areas. At the heart of many of these issues I've just mentioned are problems related to information. Indeed, one of the key lessons of the past 7 months is how information asymmetries can lead to or exacerbate disruptions in financial markets. So let me turn to a discussion of these recent events and look at how problems with information have contributed to that turbulence. To truly understand these events, it's important to have some context. And you will find in this latest issue of the FSR a detailed account of this, but let me try to summarize quickly. Despite the positive backdrop of strong economic global growth, there were signs of potential trouble in the global economy in recent years. And as early as 2003, we had flagged concerns about growing global imbalances. The high level of global desired savings relative to desired investment naturally served to drive down real longer-term interest rates, even as central banks around the world were in the process of raising short-term policy rates. But with the decline in longer-term interest rates, investors stepped up their demand for riskier assets that would deliver greater returns. This so-called search for yield led to a narrowing of spreads between yields on more risky assets and those on so-called riskless assets such as government bonds. And this narrowing of risky spreads became so pronounced and so persistent that many central banks began to question whether these spreads adequately reflected the credit risks that were involved. We highlighted this issue first in our 2004 issue of the Financial System Report, and we said a repricing of risk appeared necessary, but the real question back then was how and in what manner that repricing would take place. So that's one of the factors, the need for repricing, that has contributed to market turbulence over the summer. But other factors have contributed as well. Originators of loans, both bank and non-bank institutions, were increasingly opting to securitize the loans they made in the form of highly structured asset-backed securities. The ease with which these highly structured products were sold fueled demand for the creation of higher risk assets, including U.S. subprime mortgage loans. This in turn contributed to the global decline in lending standards. The decline in standards for loan origination combined with financial engineering spurred further greater lending. Now, don't get me wrong. Securitization per se is not bad, and securitization is not new. Securities backed by mortgages or credit card receivables have been around for many years. And indeed, the development for the plain vanilla asset-backed securities in this country in the 1990s was important, since it allowed for the appropriate expansion of credit. But more recently, we have seen the emergence of increasingly complex structured products, which were developed, as I said, in response to the demand for higher returns. And as these securities have become more complex and more opaque, it became harder for investors to determine what assets were actually backing the security, the quality of those assets, and the counterparty risks that were involved. A final point has to do with how these complex securities are valued. Generally, they don't trade in the secondary market, so most of them are valued on a mark-to-model basis. But models are just that, models, and provide only estimates of value, which can vary widely depending on the assumptions used. So it becomes extremely difficult to put a firm value on a particular security at a point in time. So all of these factors came together, and we can see that there were many factors that made credit markets vulnerable to dislocations. By late spring, spreads on lower-rated corporate bonds had begun to widen to closer to historical levels. But in the summer, we began to see rising delinquency rates and higher probabilities of default, in particular on U.S. subprime mortgages. But because of the complexity and the opacity of the financial instruments which overlay these mortgages, it was very difficult, even for sophisticated investors, to determine with confidence just how badly affected their securities were, and to determine with confidence the creditworthiness of the assets backing the particular structured security that they own. In these circumstances, uncertainty led to contagion and dislocation in money markets more generally, even those markets that had no link to U.S. subprime mortgages. Liquidity, which in 2005 and 2006 we originally thought was too abundant, all of a sudden became scarce, and investors found that the assets they assumed were liquid were indeed frozen. The lack of transparency and problems with information have clearly contributed to ongoing market turbulence. In addition, uncertainty remains about the extent to which banks are holding these securities and how much they may be required to take onto their balance sheets and what value to put on them. This uncertainty has exacerbated problems in the global interbank funding market. However, I should note that because of their strong balance sheets, Canadian banks have been less affected than banks elsewhere. Over time, market forces can still be expected to work out these problems, but markets need information to work out efficiently, so it's in the interest of market participants to make sure that parties have access to all the information that is necessary. Globally, markets for structured asset-backed securities remain under great stress. In Canada, the problems have been most acute in the market for structured, non-bank, asset-backed commercial paper. And as you know, the market for this paper has been frozen since the middle of August. But the information needed to properly price this paper is only now beginning to be made available. And with this information, investors and the providers of assets and liquidity are now progressing towards restructuring agreements in Montreal. As we go forward, now looking beyond today, as we go forward, we can expect that investors will and should demand greater transparency where it's now lacking. Vendors of financial instruments will then need to structure them in such a way that market players can more easily see what they're buying. More fundamentally, investors must take on more responsibility for research so that they can better understand the nature of their investments. But in order to do so, they must demand access to appropriate information so they can do their homework, and then they've got to do the homework. And when investors demand greater transparency, there'll be a strong incentive for vendors to provide it. Now, you would be surprised if I didn't touch on credit rating agencies, so let me touch on that issue. There's an article in our current Financial System Review that expands on what I'm going to say today. But one thing is clear, is that in the future, credit rating agencies will find it to their advantage to explain more clearly the rationale for and the limitation of their ratings for highly structured products. There are some natural self-correcting forces at work that should lead a rating agency to improve their processes. Indeed, those that do not work harder to improve will likely have fewer clients willing to pay for their services. And as I understand it, ladies and gentlemen, most of the agencies are now working very hard to put such improvements into place. Let me just say a very brief word about the role of securities regulators. In the retail market, securities regulators impose strict requirements about the information that has to be provided to investors. But they don't impose the same requirements for the exempt market, in which most of these highly structured products are sold. Now, it seems to me that some very basic disclosure is needed in every market. And since securities designed for the exempt market are usually need to carry a rating from a credit rating agency, one way to ensure that appropriate information is made available to all could be to require that issuers publicly disclose all the same information that they make available to credit rating agencies. And that way, investors would at least have access to the information they need to make informed decisions. That's one area where I think market forces are at work to bring about improvements. Another area we need to think about are the incentives that are in place for loan originators so that credit quality is maintained and appropriately priced. I mentioned earlier, in some cases, the creation of loans largely for securitization reduced the incentive for originators to maintain credit standards. And since originators were immune from default risk once the loan was completely off the books, they lacked the proper incentives to adequately assess the creditworthiness of the borrower. Now again here, it's probable that natural market forces will go a long way towards rebalancing incentives. But the question can be asked, are there ways to encourage more appropriate use of securitization? It may be possible, for example, to have asset-backed securities carry some type of branding or certificate of origination that would provide a clear incentive for the loan originator to exercise due diligence, or in extending the loan before it was securitized. Or, of course, we could look at ways to encourage originators to keep a portion of the loan on their own books. Now, these are extraordinarily important issues, ladies and gentlemen. As I said, I think the market will go a long way to sort some of this out, and we have to be careful not to jump in and try regulate or pass a law where markets will sort it out. On the other hand, there are important issues here, and these need to be addressed quickly in order that the market can begin, the market for securitized products can begin to refunction again. Now that's a review of the dislocations we've seen over the last 7 months. Let me just spend a moment talking about their implications for the bank and for our economy here in Canada. First, the impact of these dislocations on the banks really been twofold. First of all, as you know, we've undertaken open market buyback operations to make sure that Canadian banks have had access to our standing liquidity facility so that they've been able to deal with their needs for overnight liquidity. This is our normal role, and it'll continue. But in the wake of recent events, we're currently looking at whether some types of liquidity disruptions in Canada might be better addressed if the Bank of Canada had a facility that would provide liquidity at terms longer than overnight. And we're also examining changes necessary to allow the bank to accept a wider range of securities for our buyback operations. The bank's other role, of course, is to conduct monetary policy with the aim of delivering low, stable, and predictable inflation. And we've been working to ensure that the financial system has the proper amount of liquidity so that the overnight interest rate actually remains close to our target. What we've seen since the summer is a widening of the spread between short-term market interest rates, such as rates on commercial paper, and our target rate for the overnight rate. And this is important. Observing this and understanding this is important because these shorter-term market rates are a crucial link in the transmission of our monetary policy to the economy. And as the wider spreads have persisted, what they do is they represent, in effect, a tightening of credit conditions across the country at any given level of our overnight rate. These tighter conditions have come as financial market difficulties have intensified over the past few weeks, and banks' funding costs have increased globally. At the same time, there's an increased risk attached to the prospects for demand for Canadian exports, because the outlook for the U.S. economy, particularly the housing sector in the U.S., has weakened. Uncertainty related to all of the factors has led to exceptional volatility in financial markets and in currency markets globally, including here in Canada. Ladies and gentlemen, while there remain upside risks to inflation in Canada, all factors considered, the bank judges that since October, there has been a shift to the downside in the balance of risks around the projection we made at that time. And in light of this shift, we lowered the target for our overnight rate last week. Before our next interest rate decision in January, we will assess all economic and financial developments and the balance of risks, and we'll provide a full projection for the economy and for inflation. Ladies and gentlemen, as you know, and as Alan said, I'm going to be stepping down as governor at the end of January and concluding about 35 years of involvement in economic policy within the public service. And since this is not only my last speech as governor, but my last speech as a public servant, I thought it might be apt to conclude my remarks today with three of the most important lessons for economic policy that I, and I think many Canadians, have learned over the last 35 years. The first is that both individuals and firms must always be prepared to adjust quickly to changing global economic circumstances. The world's always going to evolve in ways we cannot predict, and so we must individually, as firms, and collectively be prepared to deal with change and to seize the new opportunities as they arise. Even more importantly, we should not cling to activities that are no longer economically viable, however painful that adjustment may be. Not adjusting is not an option. In the end, rapid adjustment is less painful than prolonging activities where we no longer hold a comparative advantage. And this is certainly a lesson that I, and I think most other Canadians, learned from our difficulties in the 70s and 80s. And despite the difficulty of making that adjustment today, the adjustment in our economy over the past 5 years to many economic shocks has been remarkable compared to our adjustment only 30 years ago. Second, we've all learned the importance of achieving and maintaining sustainable levels of public debt. Canadians paid a very real price in the 90s to control the growth of public debt and have wisely used favorable economic conditions over the past decade to bring down the ratio of public debt to GDP. And even though conditions will not necessarily be as favorable over the next decade as they have been, nonetheless, further efforts are needed to reduce the burden of debt service in order to prepare for the inevitable effects of aging of our population. Finally, I think we've all learned that the most important contribution that a central bank can make to the welfare of Canadians is to maintain their confidence in the future value of their money. In the 70s, we all witnessed the economic and social instability caused by high and volatile inflation. In the 80s, we paid the price of recession to get it under control. But since the 90s, our inflation targeting regime has kept inflation very close to 2%. This, together with fiscal consolidation, has helped to keep growth more steady, employment to rise to historically high levels, and unemployment to fall to levels not seen for decades. My colleagues at the bank will continue to search for technical improvements in our inflation targeting regime, but I am confident that the bank and my successor, Mark Carney, will continue to keep inflation low, stable, and predictable for the benefit of all Canadians. Finally, let me close by saying that it's been an enormous privilege for me to be able to serve Canadians for the last 3.5 decades. I'm really grateful to you and all Canadians for giving me that opportunity. And I hope that in some way, my efforts over those years may encourage others to follow in the service of Canada and its people. Thank you very much. Now, are you going to read out this?
Governor has agreed to take a few questions, which so I'm just going to sit here and read. So the first one is, where do you see the greatest differences between Canadian and American monetary policy in 2008?
In 25 words or less. Look, central banks all have the same objective, and that is to keep inflation under control and to try operate in such a way that economies continue to operate close to the level of capacity. I think the big difference is that here in Canada, we have banks with somewhat more healthy balance sheets than some of the money center banks elsewhere in the world, as number one. Number two, we have avoided so far the troubles in the subprime mortgage area. So I think we do start with a leg up vis-a-vis the United States. On the other hand, obviously, we are part of North America, and we will, as will the Federal Reserve, have to watch very closely this very fine balance between keeping inflation under control and trying to ensure that the economy works at reasonably high levels, certainly sustainably high levels of output and employment.
It seems that the Fed and the Bank of Canada were somewhat surprised in 2007 about the credit crunch. Do you see any surprises in 2008?
Well, if we could see a surprise, it wouldn't be a surprise. But look, in terms of the financial markets, we are not out of the woods yet. As I said in my remarks, we have really a way to go to ensure that markets really do have full information, because markets need full information to function well. And we do have a way to work out globally, of current problems. But undoubtedly there will be other surprises as we go ahead. But our main challenge, certainly during the next few months, will be to get financial markets working again and working properly, and particularly money markets, for which we at central banks are responsible.
Just one final question here, and is during your tenure, can you reflect on a high point?
It's been an interesting 7 years in one very real sense, that we've actually had a lot of shocks that have occurred over that period. 9/11, SARS, blackouts, more recently financial market problems. And I suppose in many ways the real high point is that our system, our financial system, so far has proved remarkably resilient. Canadians have proved remarkably adept at adjusting to huge changes in relative prices. During my tenure as governor, we've had oil at $10, we've had oil at $100, we've had a Canadian dollar at 62 cents US. Momentarily, we had it at $1.10 US. These are monumental changes. When I started, nickel, I think, was $3 a pound. It got up to $18 a pound. I mean, these are huge changes to which we all have to adjust and adapt. And I think probably the greatest thing that has happened in this decade, compared again to an earlier decade when we had momentous changes, the 1970s, is that we have adapted, that we have high employment, and that Canadians, in fact, are more prosperous. So I would say the real high point has been the strength and resiliency of Canadians, workers, and Canadian businesses.
Thank you. I'm going to call on Catherine Swift to provide some closing comments, and thank you.
Thank you, Alan. Mr. President, members of the Empire and Canadian Clubs, honored guests. Well, central bankers are renowned for being the people that delight pulling the punch bowl away just as the party's getting started. During the 7-year tenure of Governor David Dodge, the Canadian economy has enjoyed an amazing run of stable economic growth. As he just alluded to in his recent remarks, over this period of time, we have seen a number of tumultuous events, both economic and political, things like 9/11, SARS, a crisis in the insurance markets, soaring energy and commodity prices, a weak economy for our most important trading partner, the U.S., a very high loonie, and, of course, our recent challenges as a result of losses in the asset-backed commercial paper market. It's a real credit to you, Governor Dodge, that despite all of this turbulence, the Canadian punch bowl stayed on the table. In my day job as the president of the Canadian Federation of Independent Business, I've personally had the pleasure of meeting with Governor Dodge many times over the years, and also previously in his incarnation as the Deputy Minister of Finance at a time where we saw our deficit eliminated and we finally got around to starting to pay off our national debt. And I've always found him to be endlessly curious and enthusiastic about any information he could put his hands on to help him better serve Canadians. I think this was a major factor in his success. Finally, as someone who has a variable mortgage, I'd like to personally thank you for the interest rate reductions last week. And since I hear the Federal Reserve is contemplating as much as a 50 basis point, half percentage point reduction in their rates, hopefully we can see more of the same in the future. So thank you so much for your steady hand on the Canadian economy and monetary policy over the years, and also thank you for coming and speaking with us today.
Catherine, thank you. And again, Governor Dodge, thank you for coming today. That ends our lunch. Have a great holiday season.